In this video, we're going to talk about market structure. Market structure is one of the most important, but also one of the most basic and simple to follow concepts. As I spoke about previously, what we're going to do in this chapter and in this section is first of all talk through each concept, and then we're going to go and put it into processes and show you how to apply it on the charts. So for now, just dig into the education on each concept and just taking some time to learn what it is that I'm saying. So it's always good to have some notes on hand as well so that you can make notes, a notepad, a pen, or even an online notebook. But it's just good to track some of these things down and make sure you have notes so you can go and refer back to them in the future for your own trading. So breaking down market structure then, the markets move in three phases. We have uptrends, we have consolidation, and we have downtrends. It's quite simple. When the market's in an uptrend, it is moving primarily to the upside. When a market is moving in consolidation, it's actually not moving anywhere. It's just moving sideways within a range. And when the market is moving down, that is obviously where we have larger downside and the trend is pointing to the downside. So when we're in an uptrend, we want to make sure we are buying. When we're in a downtrend, we want to make sure we are selling. And when we're in a consolidation, we want to make sure that we're not doing anything and we're being patient and staying out of the market. These phases are so important because sometimes people get caught up trading the wrong way. They'll anticipate the end of a trend and people will start selling when the market is here, for example. But what actually happens here is because there's no confirmation, the trend can just continue far and far and far and lead you into a lot of losses that you don't need to get into. The best way to trade is to actually trade with the trend. So what we need to do is learn to identify uptrends and learn to identify downtrends so we can buy with the uptrends and sell with the downtrends and avoid any of the bad trades. So let's have a look at the anatomy of a trending market then. We'll use the uptrend for this example. A trend is defined by a series of highs and lows. If the market's making higher highs and higher lows, that means that the market is trending up. When the market's forming higher highs and higher lows, we only want to buy with this trend. On the flip side, if the market is forming lower lows and lower highs, we only want to be selling in that market. And if the market is forming equal highs and equal lows, we don't want to do anything yet. So looking here then at this structural point, how do we identify the higher highs and higher lows? Well, we use a break of structure. This is the arrow tool we spoke about where we have the BOS. And what this indicates is a break of structure. And break of structures are very useful because it's these that are going to initiate trades for us. The market moves in two phases. We have impulses and corrections. The impulsive move is the move in line with the trend. It's a large move that actually drives the market in one direction. The corrective moves are smaller movements that come after the impulses, but don't actually push below the start of the impulse. Corrective moves are essentially profit-taking moves. Buyers from here start taking profits here, the market pulls back, more demand comes into the market because the price is better, more people buy, and that leads to the next leg of movement. So market structure is actually a battle between buyers and sellers indicated on the chart. The buyers are in control here, the sellers attempt, but the buyers then regain control. And that is where the break of structure is formed and a new higher high is formed. And on the flip side, when we are selling, this is obviously where the sellers are in control and buyers cannot bring it back. Sellers take control, buyers cannot bring it back, and so on. So that's how a trend works. We are basically looking at the battle there. And when the market is forming higher highs and higher lows and forming bullish breaks of structure, which is what we call a break of structure in an uptrend, that is when we want to be buying. And on the flip side, if the market is bearish and making bearish breaks of structure, lower lows and lower highs, that is where we want to be selling. So that is the basic concept of market structure. We have the three phases: uptrends, consolidations, and downtrends. And when we're in an uptrend, we want to buy. When we're in a downtrend, we want to sell. And when we're in a consolidation, we want to sit on the sidelines and not execute any position. Now, how do we actually trade market structure then? Well, the thing is, to trade market structure, we have to bring in the other concepts that we're going to talk about, such as supply and demand, market efficiency, liquidity, and other aspects that we'll cover in the next few videos. So right now, you don't actually need to know how to trade the market in terms of entries, targets, and exits. But what you do need to know is how to identify market structure and the different phases of the market structure. So now we're going to dig a little bit deeper into one of these market phases. We will look at uptrends for this example to show you swing structure and substructure. So here we have on the chart a large uptrend. We obviously know the impulse, correction, impulse, correction, impulse. So this shows us that we are in an uptrend. Now, I spoke about having the impulsive and corrective moves. These can actually be indicated as swing structure and substructure. So we have the swing structure, which is going to be the in-trend impulsive movements. and the substructure comes in on the corrective movements, okay? And the substructure actually forms trends within itself. So as I say, follow the trend at all times, that is 100% true, but we can actually follow downtrends in the corrective moves, if that makes sense. So this is where things may get a little bit complicated, but I'm going to explain it as best I can. And I think if you do a little bit of practicing and you review the notes, and if you do need to rewatch the video, you will understand this. And obviously I will show a live chart example afterwards as well. So when we're looking at market structure, we actually have smaller trends within larger trends. We spoke about the impulse, correction, impulse, correction, impulse. The impulses are the large trend moves. The corrections are the pullback moves that go against the trend for a short while. Now, because markets have different time frames, we can look at a chart on a weekly basis, a monthly basis, a daily basis, a 1 hour basis, or a 1 minute basis. What this means is there's going to be trends existing within all different time frames within the substructure of larger trends. So let's say, for example, then that we were looking at a daily time frame chart. What we would see is basically a large push to the upside, a pullback, and then another large push to the upside. And what this would tell us is that the daily chart is in an uptrend. What we would also see is, say we drop to the 4-hour time frame or the 1-hour time frame from the daily chart, we would actually see smaller downtrends happening in the corrective moves. These trends can be traded themselves, so we don't just need to focus on the daily time frame. We can actually drop down lower and trade the smaller trends that happen within the corrective moves. And this is what we call substructure. So the swing structure is the overall direction of a larger time frame move. The substructure is the corrective move, and within the substructure we can actually get full trends on different time frames. So as an example, if this was a daily time frame uptrend, this may be an hourly time frame downtrend. If this was an hourly time frame uptrend, this may be a 5-minute downtrend. And what we can actually do is scale to these time frames and trade these bearish while we wait for the reversal. Then when we get a reversal, we can start to trade this structure back to the upside, which is of course that higher time frame structure. Okay, so we can actually trade both swing structure and substructure on their respective time frames, which means we can buy through impulses and we can sell through corrections, as long as we are doing it in a smart manner. You will obviously see how to do all of this later on in the course when we put things into processes, but for now it is important that you understand the concept of swing structure and substructure. So remember, everything is sort of time frame relative, and where we may see one trend on the daily time frame, there's going to be many smaller trends within that on the hourly time frame and the 30-minute time frame, and so on. So for this real market example, we're going to look at GBP/JPY, and this is the 4-hour time frame. Now, if you don't understand time frames, basically each candle on the chart represents 4 hours of time. Okay, so this is the price movement between 4 hours of time. So looking at the 4-hour chart, then we can see here we clearly had an uptrend, higher highs and higher lows until we hit this point. We had a higher high, higher low, higher high, and then we started to break through and make lower lows. So this is where the trend broke, and this is where we'd mark that first BOS, break of structure. From here then, we see we had lower low, lower high, lower low, lower high, lower low, lower high, lower low. So we can see that from this point, the trend is intact to the downside. So we know if we are trading on this time frame and we're trading this structure, we want to be moving with the downtrend, right? If we just quickly mark on these as well, so you can see the trend intact. Basically, every time the market breaks structure, that gives us a new lower low in the trend, which confirms that the trend is in play. So what we generally like to do in terms of trading, which obviously we're going to see more about, is first of all, wait for a break of structure, and then we look to sell the pullback. Now, obviously not every single time is going to give us a good trade idea, but as a general idea, what we would look for, is something like this. We're looking to sell at this point to continue the trend down. And then when the market makes a new lower low, we can then look to sell again to make a new trade with the trend. And that is basically how trend trading works, right? We wait for a lower low and then we sell the lower high. On the flip side, if we were in an uptrend, we wait for a higher high and then we buy the higher low. I did speak about substructure as well, which is the structure that occurs within the corrective moves, right? We have the impulses, corrections, impulse, correction, impulse, correction, impulse. Now, inside of the corrective move, you can see we have actually a smaller bullish trend. So if we go to a lower time frame, for example, we'll go to the 30-minute for this one, just scale price back. If we go to the 15-minute time frame, then let's have a look. We will see that within the substructure, we actually have a small uptrend. We can see that from this point, we formed lower low, lower high, lower low, higher low, and then we started moving up into this new trend. So what we can actually do is buy through the substructure. We use other concepts known as supply and demand and imbalance. We will be talking about those in the next few videos to obviously find our targets. So don't worry if you don't entirely understand the setups right now. But basically what we're looking at is just purely structure. We obviously know the structure is bearish. Then when we hit this point, I have the lower low, lower high, lower low, higher high. When we pull back in, we can then look at a higher low to buy from, right? And as we can see, the market comes in, higher low forms, we get to buy the higher low, and we get to ride the trend up. And generally, we just want to trade the substructure through the range of the swing structure. So if the swing structure is this move here, we can trade the substructure back through it, and then we know we have to get out, we can't continue it, because we can then look to sell with the swing structure. So that's the difference between substructure and swing structure, and how it kind of looks traded in the markets. We are looking overall for the higher time frame moves to trade with the trend, but then we can actually find smaller trends within the corrective moves of the larger trend, as I just showed you, and we can trade the other way. So that is actually just swing structure and substructure shown in a live market example. And if we go over to the higher time frame chart again, you will see a lot of phases in the market where we have higher highs, higher lows, lower highs, consolidation, uptrends, downtrends, and so on. So you can see, as we spoke about earlier in the video, the market moves in 3 phases: downtrends, uptrends, consolidation. Downtrends, uptrends, consolidation, downtrends, uptrends, consolidation, uptrends, consolidation, downtrend. You can see it all going down, all right? And obviously it is time frame relative. On a higher time frame, this would simply be probably just a nice clear uptrend. But if you're trading the lower time frames within that, you are going to see more of the market action. So always keep the time frames in mind, and as I just showed you with the substructure and swing structure, that's how you do that. And by this point, I think you should have a good understanding of market structure. The last thing to talk about on the topic of structure is structure reversals. We know the market moves in uptrends, we know it moves in downtrends, and we know it moves in consolidation. But how do we actually find the area where the market shifts from bullish to bearish or bearish to bullish? Now, at the end of an uptrend, we are going to often see a pattern that looks something like this. What this actually shows is a change in the trend, first indicated by a break of structure. So this is where the uptrend is coming in, impulsive moves and small corrections. But then when we have an impulse which is larger than the previous bullish impulses and actually breaks the structure through, like so, forming a new lower low, that is where we get a reversal, right? So this is bullish trend broken into a bearish trend. And from there, we're normally going to get the opposite happen. So from bullish impulses and bearish corrections, we're going to get bearish impulses and bullish corrections. And that is the first indication that we are really shifting the trend direction. Now, obviously, it's not going to be this neat all the time. A lot of the time it is, though. A lot of the time it's very, very neat to actually see this pattern form. And this is actually how we trade reversals. Obviously, don't worry yourself with the technical know-how of trades, entries, exits, none of that stuff right now. All you need to do is just focus on the structure. But you can see that this is how we use the structure to identify our reversal. So we have bullish trends, we have reversals into bearish trends, and this is one way that we get out of trades, and also a way that we actually execute trades and get into trades, which is what you're going to learn a lot about in the future. But for now, you need to understand this concept so that when you're doing a little bit of homework on market structure, you can also identify reversals. So really quick, what we're going to do is look here at a real market example. This is a trade that I took very recently. I actually took it at the day of making this video. Basically, don't worry about the other things for now. We're just focusing on structure. But what we can see here is a big bullish move, and then we have a higher high, higher low, higher high. But then what happens? We get a lower low. Okay, so what can we do? We can mark on break of structure just here, and we can actually look towards the lower high here to actually sell. Okay, so my actual trade was executed from around this point here. Which obviously in line with the structure is going to be a higher low. And this was a sell trade. And it looked a little bit something like this. Now what we do here is basically sell the higher low because we've seen higher high, higher low, higher high, lower low, breaking the trend. We know that we've gone from bullish to bearish. So what we can now do is sell into this and bring the market lower through this area here, which you're going to learn about in, I believe, the second next video. And as we can see, the market came very, very nicely through and showed that that shift in trend was, valid, was real. And we actually followed the structure there from bullish to bearish and profited from the entire bearish trend because we managed to get in at the top. And that is a great way to actually use structure. And that's a great example of this reversal pattern that you see. If we just drag it over here, you're going to see how well that fits onto the price there, where we have that kind of formation going on. Okay, and that is what we saw. That's how you eye reversals. And this is just a little example trade of how you trade reversals, but we're obviously going to get a lot more into that in the future. So what should you do now? Well, the first thing you should do is go to the markets and identify higher highs, higher lows, bullish breaks of structure, and find yourself bullish trends. Okay, identify bullish trends. Now what you should do from there is identify bearish trends. Look for areas of lower lows and lower highs where you can identify trends and just build an eye for the market and build an eye for being able to find where the market is moving up and when the market is moving down. Another thing you can do when you can successfully find bullish and bearish trends in the market is look for the reversals, what we just spoke about there, where we have a bullish trend shifting into a bearish trend, or on the flip side, where we have a bearish trend turning into a bullish trend, which is going to look a little bit something like this. And when you can find all of these things, you'll be ready to actually move on because you'll have an idea for market structure. You have an idea for uptrends, downtrends, reversals, and also the final thing you should look for is consolidation. And these areas are really not to be traded generally, but by working out how to identify these, you'll know what to look for when you're deciding whether or not a market is in a good condition to trade. So that's what you should do now. Go and do some homework, find higher highs, higher lows, uptrends, lower lows, lower highs, downtrends, bullish reversals and bearish reversals like this, and also find consolidation areas. Take some chart markups, take some screenshots. Always feel free to send them over to me. I'm always happy to help out students progress. So with that, finalizing it all, thank you for watching. I'll see you in the next video.